Hello, everyone. Welcome to this webinar on this very important topics of climate change disclosures and the legal imperative of putting climate change on the board of directors agenda. My name is Vincent Felteau, and I will be your moderator for today's session. I am personally Senior Director, Responsible Investment, Private Markets at PSP Investments. I am also leading PSP's initiative on the topic of climate change, including participating in the Investor Leadership Network Climate Change Initiative, and I'm also one of the CCLI climate experts. Before we start the formal introduction, I want to thank the Canada Climate Law Initiative, FSA SASB Quebec Group, and our broadcasting partner, Finance Montréal, for organizing this event and inviting me to be the moderator. In terms of the agenda for today, we will have two quick 5-minute presentations, and after this, we will have a 30-minute panel discussion followed by Q&A. The first presentation will discuss the legal imperative of putting climate change on the board of directors agenda. The second presentation will explain how SASB standards help investors understand industry-specific impacts and industry-specific metrics related to climate change risk. But before we start those two presentations, it is my distinct pleasure to introduce our panelists and presenters for today's sessions. Firstly, we have Ms. Kathleen Camilli. Kathleen is one of the leading economists in the US and was named several times by the Wall Street Journal and Business Week as one of the top forecasters on Wall Street. In 2014, she created her own firm, Camilli Economics, and prior to that, she was the US economist for Credit Suisse Asset Management. Kathleen now serves on the board of several publicly listed companies, both in the US and in Canada, including the board of AGF Investment Management on the TSX. Our second panelist and first presenter for today, we have Mr. Ravipal Bains, who is a corporate and securities lawyer at the Vancouver office of McMillan. Ravi has extensive experience of advising boards of directors and senior executive of publicly listed companies on governance-related matters such as fiduciary duties, climate risk, and public disclosure. He regularly assists clients in a variety of sectors, including mining, forestry, and technology. We also have Chantale Després. Chantale is currently CN Assistant Vice President, Sustainability, where she leads CN Sustainability Strategy. She works closely with key internal and external stakeholders to advance sustainability supply chain solution and drive long-term stakeholder value creation and protection. She is also a volunteer and a member of the board of Al Gore's Climate Realty Project Canada. In 2015, Chantale was named to Canada's Clean 16 in recognition of her contribution to sustainable development and clean capitalism. Last but not least, we have Marie-Josée Privyk, our second presenter for today's session. Marie-Josée is responsible for ESG innovation and customer success at Novisto, a next-generation ESG management platform empowering companies to better manage and create value from their ESG strategy, data, and reporting. Marie-Josée has significant experience in capital markets, namely as a financial analyst of small and mid-cap companies, as well as director of investor relations and ESG advisor to companies and investors. I will now pass it on to Ravi for the first presentation. Thank you. Ravi, you unmute.
My apologies, Vincent. Take two. Thank you everyone for joining us, and it's my pleasure to be here. Before I kick off my presentation, I'd like to quickly run us through Canada Climate Law Initiative. As many of you would know, Canada Climate Law Initiative is a research-oriented think tank based at the University of British Columbia and Osgoode Hall Law School at York University. It is led by Professors Janice Sarah, Cynthia Williams, and Professor Carol Liao. They're ably supported by Sonia Lee and Jovari Veldkamp. They have a fantastic team of professionals that engages in cutting-edge climate law-related research, particularly with a focus on governance and fiduciary duties, as well as they engage with a number of experts such as Vincent, Marie-Josée, and others here to spread information and knowledge with respect to climate change and duties and obligations of board of directors to large investment firms, public companies by way of board presentations and other such publications. If you're interested, please feel free to reach out to any of us or Canada Climate Law Initiative's contact information, which will be available later on. With that said, I'll kick off into the presentation. And before we jump into the core governance aspects, I thought it might be helpful just to quickly recount, because there has been a lot of movement over the last couple of years, particularly with respect to climate change and climate disclosures, on what are the, just cut through the clutter a little and see what are the Canadian regulators doing, and briefly touch on what's happening down south in the US. In Canada, over the last couple of years, the key document in respect of climate disclosure was the staff notice from Canadian Securities Administrators. And they have given us guidance, particularly to public companies, that they must understand and identify climate change risks, disclose them in public filings, and assess their impact from a financial perspective so that investors can compare the outperformers and from the in-performers in respect of climate change related performance. And we'll get to their framework and how they want this categorization and disclosure to happen. But that staff notice in Canada has been quite instructive. As some of you may also know, earlier this year, the Capital Markets Modernization Task Force in Ontario came out with recommendations with respect to disclosure of material ESG information in compliance with the recommendations of Task Force on Climate-Related Financial Disclosures. The final report is out, and the Ontario government is considering its implementation, and the key ESG/climate-related recommendation was disclosure of material ESG information, and they do get a bit granular over there. They categorize issuers into 3 categories: large cap, medium, and small, with above market cap above 500 million being large, medium being 150 to 500, and then any issuers below $150 million of market cap as small issuers, and then they have a transition period. Amongst the larger private markets, Canada has a number of large pension funds across different provinces, and in a rare joint statement late last year, the CEOs of a number of our large pension managers also encouraged ESG comparable and consistent ESG focused disclosures. And that was significant because these investors have quite a bit of influence, particularly when it comes to capital allocation. Other couple of developments of note: the Office of the Superintendent of Financial Institutions is also doing a consultation and investigating climate risk preparedness for certain federally regulated institutions. And as many of you know, the Supreme Court of Canada also issued the judgment in the carbon tax ruling, coming in favor of the government. So we have a lot of regulatory momentum developing in Canada, and there are other initiatives going on in the background that we have heard and know of that are not yet public, but regulators are looking at this issue. Sonia, if we could move to the next slide. And we won't spend a lot of time in this. As many of you know, the previous US administration under President Trump had some different priorities, but under the Biden administration, climate change is a priority, whether it's from in terms of executive action, whether it is in terms of standards for greenhouse gas emissions, whether it's the Paris Agreement, but also it includes climate disclosures. And the key organization in all of this is, with respect to climate disclosures, is SEC. So we have seen a few announcements already. They have set up a climate and ESG task force to go through climate-related disclosures. They have also issued an SEC examination staff alert with respect to inconsistencies and deficiencies in certain claims and disclosures made by funds. And lastly, we are also expecting to see a set of mandatory ESG disclosure or climate-focused disclosure rules coming from the SEC. And we'll get to why that's important, but primarily, once the big issue is harmonization of disclosure rules, so whichever way SEC goes will have a major impact on the global trends. So lots of action coming down in the South, and it's important because we have many dual listed companies in Canada who are also listed on the NYSE. So this does impact Canadian capital markets closely. Sonia, on to the next slide, please. Thank you. And this is very briefly what we discussed. The CSA staff notice, they want you to categorize risks into physical risks and transition risks. And again, there are subcategories. Transition risks, as Mark Carney notes, are the most difficult, primarily because you have to do a full 360 sweep of your organization and your business to identify where the risks are. Will your customer preferences change? Would your supplier still be supplying in 20 years? Would you have, of course, when we think of climate risk, the first thing that comes to mind often is the acute physical impacts, but transition risks take the spectrum wider. You have to look at the policy changes, the legal changes. Anyway, so once you identify these risks, you have to look at the impact of these risks. So how are they impacting my assets? Are they damaging any assets? Are they disrupting any supply chains? Are they impacting the availability of water, insurance, financing? But once you identify these, the impact of these risks, whether they're physical risks or transition risks, then you have to translate the impact into in a financial sense onto the balance sheet, onto the financial statement. Do we need to write down any assets? Are there any liabilities that will become due because of the impact of climate-related risks? Is my revenue impacted? Are there increased expenses? And then you disclose through the financial statement, the projected impacts, and through the MD&A, management's discussion and analysis, management's assessment of these risks. And this leads us very well on to the next part of our presentation. Sonia, next slide, please. Why climate change has to be put on this agenda? Because as we've just seen, the regulatory trends are so clear, and we have the obligation on the management is to put these, is to make these assessments, understand the impact on the financial assets, understand the impact on liabilities. Therefore, now in order to undertake that analysis, you have to put climate change on your agenda. It has become a legal duty. The board of directors is required to act in the best interest of the corporations. And when you're analyzing the best interests, when you're analyzing your strategic risk profile, your corporate strategy, you have to now look at the different risk profiles across your spectrum, across your business plan, and see where climate risk becomes material. Because if you do not, then you're not compliant with your legal duties. And in exercising this, the board of directors obviously have the underlying fiduciary duties, duty of no conflict, duty to act reasonably, and the best interest of the corporation, but they also have to undertake a due diligence analysis. They have to have a process by which they make these assessments. Sonia, next slide, please. And in that respect, in Canada, under the aegis of CCLI, Carol Hansen came up with a very helpful legal opinion in which she analyzed most of these issues. She went through the duty of due diligence, the duty to act reasonably and honestly in the best interests of the corporations. And what she came, her conclusion was that you have to put climate change on the board agenda. The board of directors have to consider climate-related risks as part of their fiduciary duty towards the corporation. And we will discuss several different ways to deal with, as many issues will come up. Fiduciary duty with respect to climate change is multifaceted. It is not one and done, in that there's only one type of climate risk and you look at it and you're done. It manifests in different ways, through disclosure, through governance, through strategy, and through operations. So we'll deal with all of these issues in our discussion later on. For now, I think my 5 minutes are up. I'm going to pass it on to Marie-Josée.
Thank you, Ravi, and thank you everybody for joining us today. I'm just going to take the next few minutes to present to you how SASB addresses climate-related risks and opportunities in its standards. So a very quick snapshot about the Sustainability Accounting Standards Board, or SASB. It was founded in 2011. The standards were released in their final version in 2018. These are disclosure standards that are designed to meet investors' need for decision-useful information, decision-useful ESG information more specifically. These are corporate disclosure standards. They are focused on financially material topics. In other words, those that have a reasonable expectation that they may affect the operating and financial performance of companies. They are the only disclosure standards with an industry-specific focus, and we'll see in a moment how that is relevant. And they are also designed to be cost-effective for companies to implement. It's not a huge lift to implement the SASB reporting standards. And most importantly, in the context of climate-related disclosures, they are members of the IFRS working group that was created very recently to provide technical recommendations on the new International Sustainability Standards Board that the IFRS is contemplating and everybody expects will actually create later on this year. And the first thing that they are focusing on is developing standards for climate-related reporting, and other sustainability topics will come later. Next slide, please. And so SASB recently released a climate risk technical bulletin to really explain very clearly how the standards address climate-related risks and opportunities. And in this technical bulletin, they identify that 89% of their 77 different industries are significantly affected in some way by climate risk or climate issues. Sonia, next slide, please. And so SASB identified 3 climate risk categories. So you've heard Ravi mention before the physical risks and the transition risks. They actually break out one of those transition risks specifically, which is the regulatory risks. They also identify 3 financial impact channels through which those risks or opportunities will manifest for companies in different industries. So the income statement, the balance sheet, and the risk profile. And when you think risk profile, you think cost of capital to a large extent. Next slide, please. And one of the particularities of SASB is their industry-specific focus. And the other particularity is their connection, or the connection they make between material sustainability related issues and financial performance of companies. And so what they've identified in this technical bulletin, very clearly articulated, is that climate risks and opportunities will manifest in different ways depending on the industry. And so they manifest as different topics depending on the industry, and those different topics will have different financial channels through which they will affect the value of companies. And that is also clearly articulated by SASB. Next slide, please. And so this is an illustration of the kinds of information that the technical bulletin provides. And so for each different industry, they identify which of those 3 different risk categories are most likely to be relevant to a particular industry, and then which of the 3 different financial impact channels are also most relevant to each particular industry. And so we have 3 quick examples. If you want to go to the next slide, Sonia. 3 quick examples for you. So one example of the physical risks, in this case for insurance companies. So the topic for insurance companies in this case will be environmental risk exposure. The rationale is obviously that insurance companies are facing increasing amounts of claims due to the physical effects of climate A good example is the recent storm in Texas that is estimated to have cost $10 to $20 billion. And so SASB addresses this by requiring insurance companies to disclose probable maximum loss of insured products from weather-related natural catastrophes. Next example is the transition risks, this time for the automotive companies. This will manifest as a topic called fuel economy and use phase emissions. And of course, transition to a low carbon economy presents both risks and opportunities for automotive companies. Opportunities if they increase their proportion of electric or hybrid vehicles, a risk if they fail to transition away from fuel combustion engines. SASB addresses this by requiring companies to disclose how many electric vehicles, hybrids, plug-in hybrids that they're actually selling. And the third example is regulatory risks, this time in the electric utilities industry. So it manifests in the form of the topic GHG emissions and energy resource planning. Of course, in this case, the regulatory mechanisms that will most likely implement carbon tax or cap and trade systems have cost implications for electric utilities. They may require CapEx investments, not all of which can be translated into price increases for price changes for consumers. SASB addresses this by requiring electric utilities to disclose the percentage of emissions covered under emissions limiting regulations and emissions reporting regulations. So the TCFD, as you probably are already aware, is the most prevalent, the most recommended, and increasingly the mandated disclosure framework for climate-related risks and opportunities. And it is often said that SASB and TCFD are actually very complementary because SASB is very metrics focused and tucks under the fourth pillar of the TCFD, which is performance measures and targets. And complements the TCFD's broader governance strategy and risk management narrative recommendations. And finally, next slide, Sonia. Perhaps most important to this conversation is the fact that last December, the corporate reporting dialogue, of which SASB is a member and which regroups the main standard and frameworks with respect to sustainability disclosures, released a climate-related financial disclosure standard prototype, which you see on the screen. It is obviously heavily based on the TCFD recommendations, and it was picked up by the IFRS not too long ago in the work that it is doing to create the Sustainability Standards Board, and again, focusing their work initially on their climate-related disclosures. So something to look out for and to keep following very closely. And with that, I will turn it back over to Vincent and our panelists. Thank you.
Thanks a lot, Ravi and Marie-Josée, for your great presentations. We will now move to our panel discussion. For all participants at the webinar, please feel free to insert your questions in the chat, and we will try to answer those questions as we go along or at the end of the presentation of the panel discussion, depending on our timing. Maybe to start, as a follow-up to your presentation, Ravi, what is your take on the legal imperative of climate disclosures?
Well, so I think climate disclosures are as important as the risks are important. So once you identify material business risks, you have to disclose them to the market. So if you're not disclosing material climate-related risks that you are aware of, then you have a problem that you're not compliant with your legal duties. Likewise, if you haven't even done the analysis to identify them, then it's also a problem because you're not compliant with your legal duties. So all of that to say, climate risks are material, they percolate in different iterations. They impact your strategy, they impact your management, they impact your operations, and like transition risks have many different categories. And if you're not disclosing them, you're not compliant with your legal duties. And it's not just enough to say that we have undertaken analysis. That analysis should be fulsome, should be comprehensive, and should be in a way 360, because climate risk is not just one risk factor. market and your AIF and you're one and done. It impacts through many different risks. Some of the risks you may have already disclosed, for example, in your AIF, whether it's related to transportation. They may have a different nature come down the road in 5 to 10 years. So you have to do a forward-looking analysis in certain situations, and then you have to communicate your risk profile to the market. So all of that, a legal duty, and it has to be comprehensive, the risk disclosure.
Thank you, Ravi. Maybe as a follow-up to that question, how likely do you think TCFD disclosures could become mandatory versus voluntary? And maybe a question for everybody as a follow-up, would you be supportive of regulations on this particular issue?
So Vincent, with respect to TCFD disclosures, we're slowly coming to a stage where regulators are starting to express a preference for them. So for instance, in Ontario, the Capital Markets Task Force recommended that the ESG disclosures compliant with TCFD recommendations be made mandatory. Now, the other interesting thing to note with TCFD disclosures historically were made with climate in mind, but we are slowly expanding their scope to cover more ESG focused metrics, the larger ESG issues. And the other part why regulators, I think, like TCFD disclosures, and Marie-Josée alluded to that in her presentation, so they're high-level principles-based disclosure. They're not very prescriptive in terms of metrics and granularity, and that's why they can be very well complemented by SASB or GRI frameworks. So, and as we are seeing, as the situation evolves in the US, once we have enough regulatory momentum, I think there's a good possibility that regulators will like TCFD recommendations, and obviously they may supplement it with other standards going forward, but in terms of rulemaking, they like the high-level principles-based approach from TCFD. At least that's what we've seen so far from the market.
And maybe what can be the scope and magnitude of the legal risk for companies who fail to comply with climate disclosures?
Well, Vincent, obviously you have to disclose all material risks to the market. And if you're not disclosing, if you're omitting to disclose material business risks, then then you're not compliant with your legal duties. Likewise, there's also secondary market liability. Once you get exposed to more risks, and you have a duty to disclose them on an ongoing basis, and you have to periodically review your risk profile. And as a best practice, or as a bare minimum practice, you should be reviewing your risk profile, your risk factors on an ongoing basis. Many issuers do it annually, many do it on an ongoing basis, but you review them and you disclose them. If you're not disclosing, then you're not complying with your legal duty towards the investors, and as a board of directors, you're not complying with your fiduciary duties if you're not disclosing all of the material risks that you're aware of, that your company has knowledge of. So one is the form requirement and the compliance check where you have to disclose. The other is a more substantive engagement also with shareholders. So at both levels, you have to have a comprehensive flow of information going from the company to your investors, to the larger investment community, and shouldn't only be looked at as something that you're worried regulators will come after. And they will if you're not disclosing your legal risk, but you also want to keep in mind that your investors need that information for their own assessment of investments.
Thank you, Ravi. Maybe a question for Kathleen. As a board of director, what has been your experience on the evolution of fiduciary responsibility and the integration of climate change related risks?
So the best example I can give you is the UniFirst Corporation, which is a listed company on the New York Stock Exchange, where I've served on the board since 2012. We're the second largest uniform company in North America, including operations in Canada. And so their journey has been a 40-year journey of disclosing all risks related to climate in the enterprise risk management matrix that the board reviews, but also a comprehensive risk analysis is included in the 10Q that's filed with the SEC. But this is an industry that suffered greatly in the 1970s when the EPA was created. They used thousands of gallons of water. That water comes out of rivers and lakes, goes back there. And so it's definitely been a very long journey, but a very fruitful one, because they recently were ranked by Bains as one of the top 100 sustainable companies in the United States for 3 consecutive years. And that's using the Calvert metrics, 230 ESG metrics that were used to evaluate these companies. So we're very proud of the journey, very proud of what they've accomplished. And of course, with ESG, it's always continuing. There's always something new to do.
Thank you, Kathleen. Maybe a question that's probably relevant for everybody on the panel. In terms of board members' literacy and their knowledge of the complex issues related to climate change, what are the resources available to increase knowledge in general on climate change risk and opportunities?
I'd be happy just to tell you what I've done. So it depends on how proactive a board member you are. I like to be out in front with gaining new knowledge, because board members should continuously be learning. So I've taken a number of courses on ESG to inform myself, and I took them at my graduate school, New York University. But there are many, many courses available, and I'll let someone else answer.
So Vincent, I think Chantale probably has thoughts on this as well. But as part of the board, when you have subcommittees, so the compensation or the compensation of the nominating committee, which is often a formulation, or the governance committee, you should be organizing on an ongoing basis firstly at a committee level, identify the skills and expertise that you need amongst your members and your at the board level and at the committee level, and then you organize ongoing educational events. So to go back to Kathleen's point, there are 2 levels of education here. One is at an organizational level, where you identify the climate risk profile of your company. And secondly, at an individual level, where you identify as a board member, what skills do you bring to the organization? And as many organizations do, they have a skills matrix. They identify these risks and which board member takes off, which board member has the particular expertise. So an interesting analysis that you may want to do is, for example, when we look at the management information circular for many public companies, they often disclose the educational activities or the presentations that board members were provided in the previous year. So you want to see, if you're an investor, see what educational activities for board members, that company that I'm invested in, I am engaging with, were provided. So at an organizational level, you certainly need to bring in outside expertise to help board members make sense of data, because some of this data, especially whether you're a deep technology company or a natural resources company, you're looking at a technical report from a mine. It's hard to make sense of that data, no matter how much expertise you have, without subject matter expertise. So you need to provide board members data and training. You need to bring in outside expertise when needed. And third, you need to give them time. You need to build a process by which they can consume this information, because I think the expectation of board directors have never been higher. We're asking them to do a lot of things. So we need individually, they should also be looking, but at an organizational level, we should be supporting them. Chantale, you got thoughts?
Yeah, very good, Ravi and Kathleen. I mean, I agree with everything that you've just outlined. There is an opportunity to bring in SMEs, subject matter experts, and that can be internally. So being exposed to the internal team and the experts internally, and having that reporting go up to the board, and then bringing in that external view and external experts. And I think, you've mentioned, like, this is evolving and changing quickly. If I just think, for example, of the regulatory environment in our country and now in the United States. So one of the things that we do at CN is we include information on climate change risks and opportunities in regular board update material that goes up to the board. So we have this document called the Pulse of the Business, where we've also integrated information about the evolution of climate change. Sometimes it's a regulatory update, for example, or how we're performing in our disclosures. It could be also questions that we receive from our investors, how we're working with our customers on this topic, so that this becomes an ongoing kind of feeding of information and material at every board meeting, and not just a topic of discussion at a specific committee or at a specific point in time.
Yeah. And then, so just to add to Chantale's point, one practice that we do, for example, with some of our organizations that we help, we do you can do a quarterly, or even sometimes if it's a really important investor, monitoring of their guidelines and their position papers. It's not just the investor relations team that knows what their investors are asking. It's also the board members who have, and the senior management who actually have the authority to drive those changes. So you sort of need to enable the plumbing within the organization for organizational flow. And that's where having a general counsel, a corporate secretary for the board, a chief financial officer on the financial side, all of them have to work in sync.
Excellent. Thank you all for your responses. Maybe as a follow-up to that, are you seeing fellow directors more responsive and more proactive in bringing climate change to their board's agenda?
I have seen examples where, for example, like Kathleen mentioned, she's been quite active in learning on her personal initiative. So where one director takes on the initiative and they identify issues, or they take specialized training, they do put these items on the agenda. So while it is an organizational responsibility, management and board of directors have to work together. But as an individual director, you can drive some of those changes, and you may also be in a special position within that organization. You may be the chair of the governance committee, maybe the chair of the nominating committee. So you have more of an impetus to drive those things. But certainly individual directors can, even if they may not have the authority to make those decisions, they can put their hand up and flag lots of relevant issues that in their opinion they have analyzed and seen in material.
I'd have to agree. I mean, there are sometimes particular committees that are touched by this topic. So it's either at the individual level or at the work that the committee is doing. Could be the audit committee, for example. In our organization, could be an operational committee or a safety committee that's indirectly being impacted by climate change issues. So depending on the committee and the individuals, it can be very topical as well.
Thank you. Arguably, climate change is not the same for different companies, as Marie-Josée discussed a little bit in her presentation. When we think about high emitters, for instance, their issues are quite different versus technology companies, for instance. So how would you advise the board to address climate change in that context?
So I guess I'll jump in on this one. So Vincent, with respect to, for example, traditionally and still even to this day, when we think of climate risk or when we think of ESG risk, natural resource focused companies come to the mind first, particularly in Canada, because we are a large natural resources focused economy. So for those companies, it is a competitiveness issue. If you are not performing on these metrics, whether with respect to climate or ESG risk, you risk being left behind. And many of the Canadian companies have taken up the gauntlet, and they are trying to demonstrate their corporate strategy and competitiveness by way of ESG and climate related risk. So for example, for large emitters, many of them are undertaking decarbonization plans. They're outlining their pathway to 2050. In addition to, like, historically, as a small example, we have the quarterly earnings call. I'm now also seeing a quarterly responsible investment call in certain situations, or it is tacked on to the earnings call. So for companies that are historically seen as large emitters, many see this as a competitiveness issue. On the other side, if you're in a sector where this is ESG risk may not be material, say, for example, consider tech. or climate risk, you have to still consider these issues because many of the net zero commitments have been driven by tech companies. So you can't be sleeping on the wheel either, because your standards are going to be high. You have to look at what your peers are doing, what is the standard within your industry, and the risk profiles are different in different situations. So you have to go on a very industry-specific peer-level analysis, and you cannot just put your hands up, this does not impact us. How do you consume electricity? Where is it made? How are you disclosing? Some of the best disclosure on climate-related issues, apart from natural resource companies, comes from the tech or telecom companies. So your standards may be higher if you're on those industries.
Absolutely. And I would just add that they could be more on the opportunity side as well, right? So a low emitter might enable a heavy emitter to reduce their emissions in the future. So there's, we talk a lot about climate change in the context of risk, which is real. And I always like to think about the opportunity side of the business as well, which I find very exciting. So if you're a low emitter, you might very well be a solution provider to a heavy emitting company, and that becomes interesting as well.
And to Chantale's point, Vincent, I've got a fabulous example I found was from a French financial institution, AXA. They were doing a portfolio level analysis of the contribution of their portfolio towards global warming. So they found that they were contributing, I don't remember the exact metrics, but say by 1 degree or 2 degrees. And then they collaborated with the tech company to find out in different scenarios, how much would their contribution be if they use different investment strategies, if they divested of certain assets. So you have an opportunity here, to Chantale's point, and there may be unique opportunities that you haven't even realized before, where different industries can come together and offer solutions.
Thank you, Ravi. Maybe we could move into the topic of corporate sustainability strategy. Maybe a question for you, Chantale. What do you think are the main challenges to better climate-related disclosures today?
Climate-related disclosures, it's a journey, I have to say. We've been at it for over a decade, at CN, and the foundation of it is just understanding, scope 1, 2, 3 emissions. And believe it or not, there are still companies that are working towards, having a better understanding. I think part of the challenge for many organizations today is to get a deeper view on scope 3 emissions. And we now know that a lot of the challenges that we face and the opportunities to decarbonize are really in scope 3 emissions. Data quality, I'd say, is also a challenge, right? So once you've established that footprint and have the data, then being able to obtain assurance is very helpful. I'm a believer that ESG data needs to be elevated to the quality of financial data, which means we need to constantly refine, the data that we're accessing and the quality of the data that we're actually making public across all ESG factors, including climate change. So that's just the base. And again, if I think back of my journey and the work that we've done with the CDP, we started with the very basics of just uncovering what is our carbon footprint, and then, migrated from scope 1 to scope 2 to scope 3. There's been a lot of great work and modeling done on scope 3 in the last several years, and then assurance. And then if you think in the context of the TCFD and the work that we need to do today, then we're thinking about modeling and forecasting and implications into the future, which there too is quite complicated. I mean, we operate a 21,000 route mile linear network. So if you think about physical scenario analysis in the context of a company like CN, it's complicated. The models are also evolving and refining as we all are collectively learning together around the world how we're going to do this better and better and better in a better informed way. So I would say, to have the mindset that this is a continuous improvement. You do not produce a TCFD complete report in 1 year. It is a journey, and it's refining year over year, digging deeper into the data, deeper into the understanding. What are the financial implications, getting to the assurance, and then understanding those future impacts, whether they're physical risks or transition risks. and leveraging the best models and the best thinking. So it's challenging. It's a journey. It's a journey where we're all collectively learning and refining along the way.
And maybe as a follow-up, Kathleen, to this question, you know, we know you're on the board of listed companies both in the U.S. and in Canada. As a board member, what kind of questions are the most relevant to ask management teams in regards to understanding the implementation of their strategy in regards to climate?
Well, most important questions. I would say more important than the board overseeing this is that it's embedded in the culture of the company. So I have the good fortune of being serving on the board of a company in which ESG is embedded in the culture. And so it's much easier to be a board member on that type of company than one where they're at the very beginning of the journey and there's a lot of bad things going on. So I think that it's really, I would press upon board members, it's up to them to impress upon the management team and make it part of the culture of the management team to embrace this. The events of the last year have brought this to the forefront at most companies. We see it every day in the news. It's been put forward by the investment side, and now the changes are happening in the C-suite and in the boardroom. And I would say this is a decade-long process where hopefully by the end of the decade, we will be as comfortable with the SASB, with SASB, as we are with FASB. No one goes into an audit committee meeting now and scoffs at a new FASB ruling. We look at the FASB ruling, we decide how we're going to meet the requirement, and we work towards meeting it. And I suspect that it will be the same thing with SASB. But again, it takes time. It takes time. Great to have the metrics. Great to have the metrics.
For CN, Chantale, you've been doing reporting on climate change and sustainability using the TCFD framework and SASB standards for some time. What was the impetus of that, and in what ways has the measurement-driven changes to improve performance? And to Kathleen's point on culture, how has that become part of the corporate culture?
So yeah, we've been at climate disclosure since before SASB and TCFD. So but we do use both of those frameworks. And quite frankly, when I started my journey, I'm not a sustainability practitioner by background. I come from the commercial side of the business. I was in sales and marketing and doing marketing communications. So, and just really passionate about these topics and this issue. So in the beginning, quite frankly, I was looking for international frameworks as guidance, help me understand and, have some rigor to what we're trying to do as a company in terms of disclosures. And I have to say that on the topic of climate, the CDP was invaluable to me in understanding what I've just talked about, scope 1, 2, 3 emissions, where the risks and opportunities are to the business. And that foundational work that we had done with the CDP made it so much easier for us to then translate that into a TCFD framework. And we're really seeing kind of that, connection between those two. And similarly, same with SASB. We had started our journey looking at the GRI framework and leveraging the GRI framework. And I think that a lot of these frameworks are quite complementary, actually. SASB is fantastic and includes that stakeholder material topic, and GRI allows us to go out to our stakeholders and test and make sure that we understand what is material from their perspective. And we do have some material issues on our matrix that are not part of the SASB framework. Indigenous communities, for example, and risks and opportunities around Indigenous communities come up as being material in our business, and it would not be included in the SASB framework. So I see the value in these frameworks as they emerge. and focusing for, finally more and more on materiality. I've been doing this since the days of we have to report on everything and everything's important to everyone and all stakeholders want to know about everything, which is very complicated and time consuming. And we're finally seeing this conversions around material topics and materiality. And I think that that's, the biggest benefits that come out of the SASB work in particular. So that's been a bit of our journey there in terms of disclosures.
Thank you, Chantale. That's fantastic. There's one question from the audience that came in about how should we think about providing forward-looking information, and is that a risk board should be worried about?
I think, Vincent, I'll jump into that. You have to provide management commentary, and you do that in many situations, and climate would be one of them, where you undertake an analysis. With respect to providing, with respect to the regulatory risk or the litigation risk, which often arises, what we often encourage folks to do is to do a peer and industry analysis. It depends also on the corporate strategy. Do you want to be a leader in this field, or do you want to be amongst the best in class? So you would have to do a peer analysis, a benchmarking analysis. This is the industry standard. This is, and follow it up with a regulatory review. This is what the regulators are expecting us to disclose. This is where the industry is disclosing right now. And where do you want to be? Do you want to be a leader in the industry, or do you want to be amongst the best in class in the industry? And based on that analysis, you can formulate some of your forward-looking disclosure. But keep in mind that if you have something material, and it's a material risk, you have to disclose that. But you can keep in mind, take into context how the market is making similar disclosures.
Thank you, Ravi. And there was another question for the audience on regarding the regulators, which is, are the securities regulators enforcing these disclosure obligations through fines, and any example of how they are forcing companies to disclose?
So we know for a fact that a number of Canadian securities regulators are currently in the midst of a green review. They have sent out questionnaires to companies asking for their responses and their assessment of different risk levels. And there are publications out there. Whether that the results of that review will be made public is separate, but the regulators are looking at it in Canada, specifically with respect to climate risk. So they are looking at analyzing through different frameworks to regulate different companies. And I think they did a similar analysis a couple of years ago when they came up with a staff notice. They went around and asked different questions. If this is a topic of interest to many listeners, they may also want to keep in mind that the SEC is also undertaking a similar analysis. We briefly talked about that in the opening part of our presentation. They have a task force that is looking at ESG and climate-focused disclosure. Likewise, they also have the SEC Risk Alert, where because as you might have seen in Canada, and particularly in the US, they had a number of ESG-focused funds that came up. Everybody had an ESG themed fund they set up. So now they're going through with a fine-tooth comb a number of those funds and seeing if their disclosure misleading. Do you actually have an ESG investment policy? How are you implementing that policy? So the results of that review would be instructive. The results of the task force would be instructive. And the Canadian regulators are also looking at this, at the green disclosure and trying to come up with formulating their own findings. So I hope those findings are made public so the audience, particularly our listeners, can get a sense of what is going on in the marketplace, where are the material misstatements or omissions happening.
Thank you.
I'd like to add to this, because even more important than what the regulators are doing are what the investment side is doing. So if you look at the actions of the very large investors like BlackRock, like State Street, they're very, very serious about this. They've come out directly. They've said they will vote against boards of directors who don't comply with the the standards for diversity and inclusion, for environment metrics. So I can't stress enough the importance of the investor side. Investors and individuals are investing in your company, and they care about these things. So that makes us accountable to them, to our shareholders and stakeholders.
I would tend to agree. And again, to talk about the opportunity side, beyond the investors, we're also seeing customers caring and the general public caring and potential employees caring. So, we live in a world of, increased transparency, expected rigor and action on these topics, and both sides of the coin are there, risk and opportunity, and not just on the regulatory front. And I'd say the last thing I'd say on the regulatory front is we tend to look a lot to Europe as indicators as to what might come and hit us later in the future in North America. So it's great to have a look and see what's happening with climate disclosures there, and also ESG disclosures. And, for the most part, it tends to migrate over into our direction sometime later. As these disclosures are robust and sometimes complex and take time, it's great to have a view on what might be coming ahead, so that we're not waiting until the last minute and scrambling to try to, disclose these things because we're being regulated. So that would be a tip that I would offer as well, is look to leading countries and leading companies as indicators of where things are going.
And that's I just want to second that point. That is a fantastic point. We do tend to look down south to the US, particularly on capital markets, corporate governance. But on this particular issue, they haven't had the same rigor or the pace over the last few years. So if you can identify, if you're an issuer, public company, if you can identify your relevant peers in the European market, then you have a lot of data to work off of.
Excellent point. Thank you. In terms of the stakeholder expectations, they are changing, obviously, and they really care about that, as we've mentioned. Maybe to Chantale, CN was one of the first companies to use science-based targets. What was your reasoning as a corporation to decide to do so, and how useful that was? What is your opinion as to the importance of adopting science-based targets for companies today?
I think that, I talked a little bit about just my journey and of the team, looking to these international kind of frameworks to inform our disclosures. And I have to say, it served us well right from the beginning. And we saw very positive reactions from all of our stakeholders. And even, if I think of 10 years ago, some of those fringe investors who were saying, great disclosures, we appreciate it. Some of our customers who are also leading, great disclosures, we appreciate it. So we got that kind of positive momentum right away. And that kind of propelled us to say there are benefits and value in better disclosures with our stakeholders, and we want to lead in this area. Science-based target for me came through the CDP disclosures. They partnered with the Science-Based Target Initiative, made their models available. And quite frankly, in 2016, we just took a first crack at it to see what would a science-based target look like, for our business. We weren't successful in the first round. And what came back with the Science-Based Target and CDP was, we want to better understand your industry and develop a model for transportation and railroad. So we actually had a chance to kind of have input and discuss with these organizations the difference even between passenger rail and freight rail. And again, I think we take the topic of climate change very seriously in our company. We've positioned as a leader. We see the opportunity and, as a leader, that we need to forge the way forward, be that pathfinding kind of organization. And I have to say, we have been very rewarded on the other side for the efforts that we've placed into these disclosures and to forging the path forward. And we've just recently resubmitted and had a new target approved. We were so early out of the gates that it was a 2-degree world when we submitted our target. So we resubmitted in the context of a well below 2-degree world, and also in the context of our recent acquisition a year ago of Transx, and got the approval of our new target recently, and aggressively pursuing, progress towards that target now. So it's served us well. And as we're, today, this past year and into the future, I think it'll continue to serve us very well. We're getting more stakeholder pressure, more stakeholder questions around our climate strategies, and are being, recognized for it more and more.
Thank you. We're getting towards the end. There's an interesting question coming from the audience that I think is very relevant. Obviously we spoke a lot about the risk side of climate change, but the question is more about value creations and opportunities, and how spending time looking at climate change is allowing companies to see opportunities in the marketplace and value creation opportunities in general. I would be curious to hear your feedback on that.
So I think many investors, for example, are looking at climate governance as a proxy for good governance. If you have high quality climate governance, you likely also have you're also doing other things in a good way. So in terms of value creation, a couple of points. Firstly, the world is changing, the investor expectations are changing, the regulatory expectations are changing. You don't want, in business, particularly capital markets, some industries are so competitive that if you miss one trend, you may be done. So you want to be ahead of the curve. You do not want to be following your competitors. Secondly, investors are asking more than regulators. If you want to have access to cheap capital, but from high quality investors who are going to be long-term investors who will give you the time and opportunity to execute your business plan and strategy, then you need to show them you're serious about having a climate plan, you're serious about climate governance and ESG related growth. So it helps increase your access to capital. Thirdly, in terms of your overall profile, this is a material corporate strategy issue. When somebody is doing an analysis, when you're in an M&A transaction, when you are in a large public company capital raise, people are going to analyze your business profile and your business risk and your corporate strategy from every different angle. And having done a 360 review, this allows you to have very meaningful conversations, and it allows you to access capital, allows you to access talent, and it allows you to have high quality partners from the same industry and different industries. If CN is a leader in climate disclosures, they are going to be expecting similar things from the peers in different industries who they're going to be partnering with. So it offers up loads of opportunities, never mind the fact that competitiveness issue within your own industry.
Excellent. Thank you, everyone. It's time is up. Unfortunately, I think we could have continued for hours. It's been a fantastic discussion. So thanks for the audience. Thanks to the audience for joining in, and thanks to our fantastic panelists. I wish you all a great day.